So today we're going to kind of just take it easy a little bit. I've thrown a tremendous amount of information at you, okay, throughout the course of this semester. So today is just kind of a little bit of a breather, and we're going to talk a little bit more just about the capital markets as a whole, the history of the capital markets, historical returns. We're going to get into a refresher, a little bit of math, okay, revolving around standard deviations as it pertains to volatility, as it relates to the level of risk that you're taking. And if you remember, you should always be compensated for the appropriate level of risk that you are willing to accept within your portfolio. Okay, so it's kind of it's an easier lecture, okay, than you're probably accustomed to. All right, but there's still going to be some math behind it. You can't escape it. I'm sorry. All right, so chapter 12, we're going to talk a little bit more about the two different ways that we can go about calculating returns. Question, is the exam going to be in Excel file or on Connect? The final exam will be on Connect. Okay. So we have a geometric mean and we have an arithmetic mean as two methods that we can use to calculate the returns on, particular investments. And we'll talk a little bit about what those two are and when one is more appropriate than the other. We're going to get into the different asset classes within the capital markets and looking back over, the historical periods of time as to which asset classes have performed, outperformed, underperformed versus others. Okay. We're going to get into a conversation around standard deviation, okay, because it's very, very important that you understand that particular risk metrics, because that relates to the volatility, okay, of the particular investment that you might be looking at. And when we think volatility, we need to be thinking risk and reward. So if you have an investment that is more volatile over a historical period of time, then you ought to see higher potential reward, okay, because you're taking more risk. You're willing to accept more volatility in that particular holding. And if you're willing to accept more volatility, AKA accepting more risk, then you ought to be rewarded accordingly for taking that additional level of risk. And then we're going to get into the final bullet here, which is the three different forms of market efficiencies, okay? Strong, semi-strong, and weak form, and how that relates back to how equities are priced within the markets. All right, so when we think about the risk, return, and the financial markets as a whole, we can go back in time, all right, and we can examine all of the returns within the markets to kind of give us a better understanding about what are some expected returns. What should we expect from certain asset classes if we look back at their historical performance over a long enough period of time? Okay, and we can go back in time and we can also see what the expected returns would look like under various scenarios, right? Oil embargoes, Middle East wars, the coronavirus pandemic, and we can kind of get a feel for what the expected returns should be in normal times versus boom times versus recessionary times versus one-off pandemic times like we're in now. So we can look back at history, okay, and we can analyze historical returns to help us better understand the potential for future performance. Nobody's got a crystal ball. Nobody can tell us what's going to happen tomorrow, literally as in tomorrow, based on what happens today. Okay, so if you haven't voted, please go vote today. One of the single most important days in your lifetime. All right, if you're eligible to vote, don't waste it. Go vote today. All right, I'll be doing it as soon as we finish up class today. All right, and then we'll talk a little bit about some of the lessons that we've learned from the capital market history. All right, there is a reward that goes along with how much risk you're willing to take. All right, and you need to make sure that you're being rewarded appropriately for the commensurate level of risk that you're taking. Okay, so the greater the reward, the more money you want to make on an investment, Okay, the greater the risk you've got to be willing to take. Okay, that's just the way it works. You don't get one without the other. We all want that, but it's not possible. So when we think about just the basic form of what we call a dollar return, so the total dollar return is equal to the income that you receive from your investment plus the capital gains or losses if you took a loss due to the change in price. We saw this when we looked at the holding period return last week or 2 weeks ago when we looked at the equity valuations. Okay, the income from an investment, the dividends that you receive, plus the change in price on the stock that you bought. So in this example, you bought a bond for $9.50 a year ago. You received 2 coupon payments of $30 each. So you got $60 of income. Okay. The bond is now trading at $9.75. So what's your total dollar return? Well, you got $60 of income from the coupon payments, right? And you made $25 on the actual bond purchase itself. So $9.75 minus $9.50. So you made $25 on that. So your total dollar return on that investment is 60 plus 25 or $85, right? So you made $85 in total, okay, on the initial $950 investment. Okay. So that's what the dollar return means. And then we look at percentage returns. So in the previous slide, it's in pure dollar form, right? Which is great. It tells us how much actual money we actually made, right? But what we care about is sometimes what percentage return did I get on that money? Okay, what does that $85 translate into in terms of percentages? Well, we just convert everything into percentage terms. All right, the dividend yield is the income that we got, the $60 divided by the price we paid for it. Okay, the capital gains yield, the 975 minus 950. So 975 minus 950 is the $25 divided by the 950 that we paid. And so therefore our total return, which is what we care about, right? We care about total return is the dividends that we received, the dividend yield that we received, plus the capital gains yield. Okay. So when we think about a particular stock, all right, that we bought for $35, okay, and when we received $1.25 of dividends, right, and the stock's now selling for $40, what are our percentage returns? Well, we got to break it into the two pieces. So what's our dividend yield? Well, we got $1.25. We paid $35 for the stock. So the yield that we receive based on our dividends is 3.57. Okay. Our capital gains yield deals with the buying and selling of the actual stock itself. So we bought it at 35 and we sold it for 40. So we sold it at 40 minus what we bought it for, divided by what we bought it for. So we've got a 14.29% gain on the stock itself, plus a 3.57% return on the dividends that we received. So our total return, which is what we care about, is 17.86%. Okay, so total return is comprised of two things, dividend yield and capital gains yield. Okay, those two things put together give us the total return for an investment. Okay. So why are financial markets even in existence? Why are they important? Okay. Well, it allows companies, governments, individuals to increase their utility. It allows them to generate more wealth. And when they generate more wealth, they have more utility. They can go and do more things. They can innovate. They can create new products. They can change old products. They can, offload products that aren't making any money any longer. So the financial markets are an avenue that give companies, individuals, and governments more utility. All right. Savers, we have the ability to invest in financial assets that grow over time. Okay. So we're deferring consumption. Okay. And we're earning a return to compensate us for doing that. Okay. We're not going to use our money now. Okay, we're going to save that money, and As a result of being willing to save that money, we want to get some return on that money. So we're deferring consumption of those funds to a future date. And as a result of doing that, as you've learned in this class, your money grows via the time value of money formula on a compound basis. So you're deferring consumption so that you can earn a higher reward, earn more money that's going to compensate you for deferring that consumption. Okay. When we have financial markets, borrowers have better access to capital, all right, so that they can invest in productive assets, right? Imagine if we didn't have the financial markets, right? And there was no such thing as a home mortgage. Everyone had to pay cash for their homes, right? The financial markets allow us to increase our utility. We have a better quality of life when we live in a home that we own. Okay. And that better quality of life psychologically translates into doing a better job at work. And when we do a better job at work, we get a bigger bonus at the end of the year, or we get a higher salary. Okay. So when we have access to the financial markets and we're capable of borrowing, okay, when we borrow, we can invest in productive assets. Okay. So the financial markets, in addition to being very beneficial, obviously, to savers and borrowers, or buyers and sellers, if you want to think of it that way, right? It provides us with really great information about the returns that are required for certain levels of risk. We can go back in time and we can look at, okay, what is the historical return for the small cap asset class versus the treasury bills? Okay, one has very low risk because it's backed by the full faith and credit of the United States government, and one is potentially purely speculative as it relates to a small biotech company. Okay, we have information that can give us an idea about what the expected return is for the various investments we might be looking at. So if we look back in time, this is from 2015 back to 1925. We look back at some of the various asset classes. Okay, this gives us an idea of the levels of return. So a $1 investment that was made back in 1926 would have turned into the final values that you see at the end of the trend lines, okay, out in 2015. So we can see that the highest performing asset class within this group is the small cap stocks. Okay, the green line. Okay, over a period of time from 1925 to 2015, that $1 investment would have turned into $33,000. Okay, the next best asset class is the large company stocks, large cap stocks. Okay, these are companies like, in today's world, there would be, Microsoft, Intel, Netflix, Disney, Apple, Google, Amazon. Okay, large cap companies. Okay, second best, but look at the difference in value. Okay, you're talking about almost a 5.5 times greater return on the small cap investment versus the large cap investment. There's a huge gap between the two of those asset classes. But if you look back at the volatility, you'd have to be willing to stay in the market, not pull any of your money out ever. Okay, that's what you'd have to do. And you'd have to stomach this significant decline back in the Great Depression, right? You'd have to keep your money in. You'd have to withstand that huge drop in the small cap asset class. Then you'd have to withstand all these much larger variations in the price of this asset class as it went from, the period from 1926 to 2015. So you'd have to be very disciplined from an emotional intelligence standpoint to believe that it's going to recover and you don't sell. Okay, so return and risk. Okay, you had to risk a lot to get that level of return, right? So that's what we're going to get into in today's conversation. And then if you look at the lowest risk, the lowest volatility, you're looking at inflation. Okay, just the normal cost of goods and services rising over time. Okay, all right, and then you got treasury bills, T-bills, right? What's considered to be like the risk-free asset. If you were going to invest money in an asset class that essentially had zero risk, then you would be purchasing treasury bills, T-bills. Okay, and when we start talking next week about things like the Sharpe ratio, or producing alpha within a portfolio, or when we start talking about the capital asset pricing model, and we bring this variable into the conversation that relates to the risk-free rate of return. The risk-free rate of return is the rate of return that's dictated by the treasury bills. Okay, that is the classic risk-free investment that everything else gets measured against when we talk about risk premiums. So numerically, if we look at large cap versus small cap versus corporate bonds versus inflation, okay, we can see that the small cap stocks had an average return over that period of time of about 16.6%. Okay, just a straight arithmetic average. Large stocks, 12%. Corporate bonds, about 6.3%. T-bills, 3.4%. And inflation over that period of time was approximately 3%. Okay, so we can see the difference. So when we look at inflation versus long-term government bonds, we can see that long-term government bonds have a 3% risk premium over inflation, okay, or a 2.6% risk premium over the risk-free rate of return, which is the U.S. Treasury bill. Okay, so we think about risk premiums. Okay, we're thinking about the deltas. Okay, we're thinking about the difference between the actual rate of return for an asset class or an investment and that risk-free rate of return. Okay, so the risk premium is that delta between the expected return of the investment that you're looking to make and the expected return of the risk-free asset. Okay, so it's the extra return that you're getting for taking the level of risk that you're willing to take. T-bills are what are considered to be the risk-free rate, so everything is kind of going to get marked against that. And so the risk premium is the return over and above the risk-free rate. So if we go back to that slide just prior and we look at the average returns for all of those investments, those are the actual returns for each of those different asset classes. And we can see when we look at the risk premiums, okay, obviously the risk premium for T-bills is 0 because this is the risk-free rate of return. So your average return minus the risk-free rate gives you the risk premium. All right, and you need to start understanding that concept because we're going to continue to come back to the risk premium, all right, this lecture and for the next 2 lectures. Okay, so the risk premium is simply the difference between the actual rate of return and the risk-free rate of return. So when we look at the risk premium for the large cap stocks, 12% minus 3.4%, okay, is 8.6%. So the large cap asset class over the 1926 to 2015 timeframe, okay, had an average risk premium of 8.6%, okay, above the average risk-free rate of return. Okay, so risk premium, difference between the actual rate of return and the risk-free rate of return, which is why we have 0 here for the risk premium for the treasury bills. So when we look at the distribution of returns, okay, from large cap stocks. So for the next few slides, we're going to be getting into some of the things that you learned in your business analytics or statistics class, okay? So when we look at a frequency distribution of the returns, okay, for large cap stocks between 1926 and 2016, we can kind of see a shape beginning to develop here, okay? We can see clusters of returns. We can see that the largest number of returns, positive returns, is in that 10 to 20% range, and the years in which those returns occurred, okay? So the frequency distribution tells us, okay, gives us a shape to the return, the distribution of the returns around the average. Okay, so when we go back to the previous slide where the average return, right, is 12% for large cap stocks, and 12% falls probably somewhere like right in here. Okay, so there's your mean, right? And we can look at a distribution around the mean to calculate standard deviations to tell us how volatile the returns are going to look like based upon the historical patterns within the market. So we can see that the vast majority of the returns, within the market fell between negative 10%, so minus 10% return, okay, and a positive 30 to 40%. So the bulk of the returns that have occurred within the market from 1926 to 2016 fell within that range of negative 10% to positive 40%, okay? The vast majority of the returns are going to fall within that. And then based upon the frequency of the returns, we can calculate standard deviation. We can calculate AKA volatility. And based upon the volatility, we can get an idea of what our expected returns are going to be for this particular asset class. Okay, so we have somewhat of a shape. There's definitely some kurtosis, okay, and definitely some skewness within this particular graph. All right, we're not going to, if you take 317 with me, we'll get into more about skewness and kurtosis. Okay, but just understand that skewness relates to how the curve shifts from one side to the other. Okay, like this is shifted more to the right-hand side, and kurtosis is more about the steepness within which the variation exists around the mean. Okay, so just if you take 317 with me, we'll get into that. All right, so, but it's a good distribution of returns, all right, between minus 10% and positive 40%. Okay, so when we think about variance and standard deviation, right, and you are going to have to calculate, okay, variance and standard deviation as part of the homework assignment and as part of the final exam. So you need to understand how it works, right? So variance and standard deviation measure the volatility of the asset class returns, right? So the greater the volatility equals the greater the uncertainty equals the greater potential for reward. Also, the greater potential for loss, right? You don't get one without the other. So when we look at the historical variance, right, we're looking at what's called the sum of the squares, right? So we sum of the squares, the deviations from the mean, divided by the number of observations that we've made minus 1, right? I'm not going to derive that, all right? You should have learned this in your business analytics class or your statistics class, but nonetheless, Excel has a function that'll do all of this for you. Okay, so that's great news. And then the standard deviation is nothing more than the square root of the variance. Okay, so standard deviation, or sigma, okay, is the square root of the variance, and the variance is sigma squared. Okay, so once we calculate the variance, all we have to do is take the square root of the variance and we get the standard deviation. So let's look at an example here. So we've got 4 years, all right, where we've got an investment that produced some actual returns. Okay. We calculate the average return to be 10.5%. Okay. We now calculate the difference, the deviation from the mean for each year. So 15% minus 10.5% is 4.5%. Okay, and we do that for every year. Okay, then we square the deviation. And why do we square it? Because we need to get rid of the negatives. That's pretty much the reason why. All right, so we square the deviation, and then the sum of the squares, we then sum all of the squares to get to 0.0045, right? And so to calculate the variance, we take the sum of the squares, okay, sum of the squares, and we divide it by the number of observations of 4 minus 1. So 0.0045 divided by 3 gives us a variance of 0.0015. And then when we take the square root of the variance, it gives us our standard deviation of 0.03873. Okay. Now, what's that telling us? Well, at the moment, we haven't quite gotten there yet. Okay, so just stick with me for the next couple of slides and we'll see how this becomes an exceptionally important number to look at as it relates to, okay, volatility. Okay, the probability that a return is going to exist within a range around the average return. Okay, what percentage of the possible outcomes are going to exist between the average return plus or minus 1 standard deviation, plus or minus 2 standard deviations, plus or minus 3 standard deviations. And when we look at the frequency distribution for these various asset classes, okay, this gives us an idea of volatility. Okay, when we look at large cap stocks as it pertains to small cap stocks, we see we've got a cluster, you know, somewhere in the middle of the returns. Okay, but we don't have a lot of tails. We don't have a lot of like super high returns or a lot of super big losses, right? It's fairly well contained around the mean. But when we look at small cap stocks where the standard deviation is at 32, okay, we can see now we're starting to get some tails, some pretty big losses, some pretty big gains out here to the right side, okay? So the volatility is a measure of the frequency within which the probability that certain returns are going to occur, okay, based upon the historical patterns for the particular investment that you're looking at. Okay. So the higher the standard deviation, the more volatile that investment is. And if the higher the standard deviation equates to higher volatility, AKA more risk, then you ought to see the higher returns for the most volatile, the highest standard deviation investments. And you do. Small cap had an average return of 16.6, standard deviation of 31.9. Okay. Large cap stocks had an average return of 12% with a standard deviation of almost 20%. Okay. The question that you now should be asking yourself is, am I really being rewarded for taking on that extra risk? All right. So this is great. The numbers kind of tell us directionally, yeah, okay, I'm taking on more risk, therefore my return should be higher, and that's what I see. But let's look at it through a different lens. The standard deviation of the small cap stocks of a 32, right, is roughly 50% higher than the standard deviation of large cap stocks, right? So we're just going to call this 20% and we're going to call this 30%. So the standard deviate, the difference, okay, you're taking on about 50% more risk by investing in small cap stocks than large cap stocks, okay? From a 20 to a 30, 50% more risk. Are you getting 50% higher returns for the investment in small cap stocks versus large cap stocks? Well, 50% of 12 is 6, 6 plus 12 is 18. So if you were taking the same 50% level of risk and you should be getting the same 50% return increase, then you should expect to see an 18% average return on the small cap stocks. So is 16.6 close to 18? Yeah, it's close. All right. But instead of just looking at the raw numbers, we need to sometimes start thinking about things in terms of relative risk. And is that increase in relative risk that we're taking, are we getting the commensurate level of return for that extra level of risk? Okay. And we can see with treasury bills down here that there's essentially no variation in history. And that's what we saw on the line graph from 1926 to 2016. We saw very little variation. The predictability of US Treasury bills is pretty high, right? It's got a standard deviation of about 3, right? Which is pretty tight. We can generally predict what's going to happen with the risk-free asset when we have a distribution curve that's so tightly packed around the mean. And again, if we get into 317, if you take 317 with me, we'll talk about kurtosis, the tightness within which those the frequency, those individual returns occur around the mean. All right, we'll talk more about that. So for the purposes of this class, we're just simply going to be talking about normal distributions. Okay, the standard Gaussian, bell curve that everybody's used to seeing. So the normal distribution, this is probably just a refresher for you, so stick with me for the next couple slides. All right, the normal distribution means that the distribution of returns, all right, is symmetric and bell-shaped around the average return. Okay, it is equally as populated on the right-hand side of the mean and equally as populated on the left-hand side of the mean. Okay, so it is completely defined by its mean and its standard deviation. Okay, so when we look, all right, at this, okay, and we look at large cap stocks, okay, it seems like it's a relatively even distribution. Okay, relatively even distribution, even though it's tightly packed around the mean, there still looks like, okay, from a purely graphical standpoint, that there's an equal number of positive returns and an equal number of negative, lower, like minus standard deviation returns around the mean. Okay, so when we think about the normal distribution, this is what we're looking at. So the probability of a particular outcome, okay, in a normally distributed population size, sample size, okay, looks like this. We have, so the average return, right, on the large cap stocks was 12%. That's the mean, 12%, straight up the middle at 12%, right? The most frequency, the most occurrences, okay, the average return for the large cap stocks was 12%. Okay? And then when we looked at the standard deviation, okay, for the large cap stocks, the standard deviation was 20%, okay, 20. So keep that number in mind. Right? So when we think about the normal distribution and probabilities of outcomes, and we think about the mean, 12%, plus or minus one standard deviation around the mean. So the deviation was 19.9, okay, so 19.9 plus 12 gives us 31.9% at the mean plus one standard deviation, and negative 7.9 as the mean minus the 19.9% standard deviation. When we do that, what that tells us is that 68%, okay, 68% of all of the possible outcomes, probable outcomes, in terms of returns in large cap companies, 68% of the returns are going to fall within the mean plus or minus one standard deviation. Okay, 68% of that time. Okay, and if we go back and we look at, the returns, okay, the minus was 7.9, right? Minus 7.9 is somewhere in here, and it was plus 32. So plus 32. So we can see, if we look at this collection, we can see that that makes a lot of sense, because that's what we talked about at the beginning of the lecture. The vast majority, right, 68% of the probable outcomes, and in this case, actual outcomes, did occur within that minus 7.9% and positive 32%, right? Okay, and we stretch it out even further now, all right? So the mean plus two standard deviations and minus two standard deviations. When we go to two standard deviations around the mean, now we see 95%, okay, of the probable outcomes are going to fall within the mean plus or minus two standard deviations, right? And then we stretch it out to three standard deviations. And then we say 99% of the probable outcomes are going to fall within that plus or minus three standard deviations around the mean on a normally distributed population. Okay, so you need to know what these are. All right, so 68% of the outcomes are going to occur between the mean plus or minus 1 standard deviation. 95% are going to occur within the mean plus or minus 2 standard deviations. And then finally, 99% are going to fall within the mean plus or minus 3 standard deviations. Okay. So, market volatility, right? 2008, 2009, one of the worst years in our worst 18 months in the history of the markets is outside of the Great Depression, right? Okay. The S&P dropped, pretty much close to 40%. It lost 17% in 1 month alone. All right. So there was a lot of volatility. And again, remember, where there's volatility, there's opportunity. Okay. So, if you were an active investor during 08 and 09, okay, despite the fact that the broad markets were plunging 37% or 17% in 1 month alone, there were a lot of opportunities out there. Okay, there were a lot of opportunities out there to take advantage of during that high volatility time. Right? And then once the Great Recession started to recover between March of 2009 and February of 2011, okay, so just 2 years, all right, the S&P 500 doubled in value. Okay, it went from like 7,000 back to 14,000 just in a 2-year time frame. Right? So volatility, being willing to take risk, being willing to put your money into a market that just got decimated, right, rewarded you, okay, by doubling your value. Right? So when we think about how we go about looking at calculating the mean, right, there's 2 different metrics that we can use, 2 different methods that we can go through to calculate the mean. We've got the arithmetic mean, which is what you're used to, right? Sum them all up, divided by the number of observations. Fine. You're all used to that. So it's the return that's earned in an average period over multiple periods, right? Where each return is independent upon one another, okay? Each return is independent upon one another. It's very important, okay? And then we have the geometric mean, all right? And the geometric mean gives us kind of an average compound return, okay, per period over multiple periods, okay, where the return for the next year is dependent upon the return from the prior year, okay, which is dependent upon the return from the prior year, okay, so the returns are dependent upon one another, okay, within a geometric average calculation. Okay, and that tends to be more applicable for investment portfolios, right? Because we care what companies do from 1 year to the next, decisions that companies make last year and how those decisions are going to influence the returns this year. Okay, so we do care about that dependency year over year. So from an investment portfolio standpoint, we need to understand the difference between just a straight up arithmetic mean and a geometric average. Okay, so when we look at the formulas for these here in just a second, all right, you're going to come to see that the geometric average is always going to be less than the arithmetic average unless all of the returns are equal to one another. Okay, so question. I know the question is, well, which one should we use and why should we use it? Okay, so when we think about how these 2 different return calculations, average calculations work, right? And we look at the differences between the 2 models. The arithmetic average, okay, so where the returns are independent of one another, okay, is going to create kind of an overly optimistic scenario. We're talking about periods of time over long time horizons, okay, 20, 30, 40, 50 years. Okay, if we look at the geometric mean, okay, we kind of go the opposite direction. Okay, it's overly pessimistic, overly negative, okay, for the short-term time horizons. So the answer kind of depends upon what your planning horizon is and what you're looking at trying to calculate. Okay, so if we're dealing with a historical period of time that is, 15 to 20 years, okay, or less than that, then using the straight arithmetic average is totally fine. Right? If we're talking about a period of time of 20 to 40 years, okay, then we can calculate the 2, one arithmetic mean, one geometric mean, and average them out and use that, right? And if we're looking at a period of time that is greater than 40 years, then we'd probably be better served using the geometric mean as our primary metric, because at that point, over a 40-year period of time, right, the returns, they are dependent upon one another. Okay, they become dependent. If you've had a company that's been around for 100 years, okay, decisions that have been made over periods of time generate returns that are based upon prior returns. And so therefore, over that long time horizon, the geometric mean becomes more representative of the business as a whole. Okay. So when we look at what is the difference, okay, here's how we look at it. So arithmetic average in this example is exactly what you're used to. 5 plus a -3 plus 12 divided by 3. Done. The arithmetic average is 4.67. Okay. Independent returns, not based upon prior returns. So 5 minus 3 plus 12, sum it up, 14 divided by 3 is 4.67. Okay. That's what you're all used to. The geometric average, okay, on the other hand, right, and you'll see this formula within the text, but nonetheless, the geometric average creates the dependency upon prior year returns. Okay, so obviously on day 0 of a company, we start with 1, all right? So that's our normal growth rate. We're not growing yet, all right? So in the first period, we had 5% growth over our base year, right? So we have 1.05. Right, so 1.05 times 1 tells us that we had a 5% return. Okay, so we had a 5% return in the first period. Okay, and then in the second year, we actually had a negative return. Okay, so it's no longer 1, it's 0.97. Okay, so 1.05. Okay, then it's times 0.97, and then it's 12% more than what we did in year 2. So we're creating that dependency as we move through time. So now it's 1.12 times the 0.97. So we have 1.05 times 0.97, okay, because we're 97% less than what we were in year 1, okay? And then times 1.12 because we were 12% more than what we did in year 2. So that creates the dependency. Okay, so 1.05 times 0.97 times 1.12, okay, all of that, okay, gets raised to 1 divided by the number of observations and then minus 1. All right, that's the formula for the geometric mean. All right, and that's in your text and you can go and look at it. There will be a question on Connect that deals with calculating each of these two averages. All right, so we can see that the geometric average by definition is always going to be less than, okay, always going to be less than the arithmetic average. Okay, and it makes perfect sense because you're dividing by a few number of observations. Okay. So when we think about efficient markets, right? What are we talking about when we say the markets are efficient? You've heard me say that multiple times throughout the course of the semester. Okay. If you believe in efficient markets, then you believe that the stock prices in existence at any given minute, second, microsecond in time, you believe that they're in equilibrium and they are fairly priced. Okay. If you believe in capital markets that are efficient, that's what you believe, that stock prices are fairly priced at any second of time. Okay. And if the markets are efficient and if the stock prices are representative of being fairly priced, then the second bullet says that if you believe that and if markets are efficient, okay, then it's not reasonable for you to expect abnormal or excess returns. Okay. If the expected return of the large cap asset class is 12% and you believe in efficient markets, then you should expect a 12% return on your investment. You shouldn't expect 13 or 13.5 or 10.5 or 9. If you believe in efficient markets, then if that's true and the prices are representative of being fairly priced, then you should not be able to generate abnormal or excess returns. Okay. In reality, markets are not necessarily 100% efficient. And we'll talk about the 3 different forms of market efficiency here in a second. So you need to understand this final bullet very clearly, okay? Efficient markets does not mean that you cannot earn a positive return on your investment, okay? It simply means that you should not expect to earn abnormal or excess returns on your investment. Okay, so if you believe in efficient markets and you believe that the large cap asset class, is an efficient asset class, then you should expect to receive a 12% return over a long period of time with that investment. Right? You're still making money, you're still making 12%, right? But you should not expect to get anything more than 12%. Right? So efficient markets do not imply that investors can't earn a positive return in the market. Okay? It just means that they should not expect to earn abnormal or excess returns. So when we think about the reaction of a stock price to some news, okay, all right, let's just say a small biotech firm is about to release or just put some news out, okay, that it's got a new drug coming to market to cure the coronavirus. Okay, hey, great, that's awesome, right? If we think purely about the efficient market theory, okay, then the second that, so the days leading up to the announcement from this biotech firm about the vaccine, the price should be flat, right? The price should be trading at fair prices based upon all the publicly known information, and therefore the price remains flat on the days leading up to the announcement. And if you believe in the efficient market theory, then the instant that news is put out into the marketplace related to the vaccine of the coronavirus, okay, then the stock price should immediately jump to its next fair value price based upon the now present information related to this vaccine. The efficient market theory would say that it should step change immediately on announcement day, immediately up to its new fair value price as a result of the vaccine being presented to the marketplace. Right? And then it would stay at the new level until the next news hits, right? That's the efficient market reaction. But in reality, we know that's not exactly how it works, okay? And in the case of a coronavirus vaccine, right, we probably would experience something like the overreaction, where the price actually pops up a little bit higher than what the fair price is. Right? There would be a lot of euphoria in the market, a lot of buyers wanting to get in on this new vaccine to cure the pandemic, which would pump the price beyond what the efficient market price would suggest. Okay, so we have this overreaction, okay, and we see it all the time in the markets. And then the days after the announcement, as the news kind of starts to settle in, the price kind of reverts back to what we believe the fair value of the investment is. So you get this overreaction and then a correction kind of in reality. Sometimes you can also get the other way, like the delayed reaction, right? Maybe even though they've got a vaccine, okay, they're having a hard time manufacturing it to get it to market. Okay, so there's not an overreaction, there's kind of a delayed reaction. All right, people are like, oh, hey, well, that's kind of cool, but we're going to wait a little bit to see how quickly you can actually get this into production and how many people are actually going to be able to get vaccinated or want to get vaccinated. So you get this kind of delayed reaction where the stock price moves up slowly to the more fair valued price. Okay, so efficient market, you'd see the step change, but in reality, you're going to get one of these kind of overreaction and correction or delayed reaction scenarios. Okay, so what makes markets efficient, right? Well, We make the markets efficient. The investors make the markets efficient. The savers, the borrowers, we're the ones who are creating the market. This desire that we have to defer consumption into the future. And in return for deferring consumption, we want to get a return. We're taking risk in order to do that. We create the efficient markets. So we're all out there doing research. As new information comes to the market, right? Prices of stocks and bonds change on a second by second basis. The prices should be reflective of all of the information that is available to the public. Okay, so prices that exist, this is very important, prices that exist should reflect all available public information. One person should not have more information than the other person. In reality, it's not exactly that case, and we'll see that here in the three different forms of efficient market theory. So if all of a sudden, all of us stopped researching, all of us stopped trying to analyze the data that's provided to us by all of these companies, if all of a sudden all of that stopped, there'd be no markets. There would be no markets. There would be no buyers and there would be no sellers. Okay, so we make the markets efficient, right? So again, common misconceptions about efficient markets. Efficient market theory doesn't mean you can't make money. It just means you should not expect to make abnormal amounts of money. Okay, what it means is that on average, you're going to earn a return that is commensurate with the level of risk that you're willing to take. Okay, and that there's not a bias in the prices that can be exploited to earn excess returns. Okay, again, we're talking about efficient market hypothesis here, efficient market theory, right? In reality, okay, this does happen. Okay, there are inefficiencies within the market. Okay, if you think back to one of our first lectures about, behavioral finance, okay, investors will behave irrationally many, many times. And once that irrational behavior makes its way into an investment, okay, you can find a dislocation between reality and efficient market theory. Okay, and that dislocation is what we call arbitrage. Okay, and hundreds and hundreds of companies exist for the sole purpose of finding those sometimes minuscule inefficiencies within the market and taking advantage of that all of a sudden out of balance risk-return ratio. Okay, so in reality, this does happen, but for the purposes of the efficient market hypothesis or the efficient market theory, okay, it says that you should not expect to earn higher or abnormal or excess returns. Okay, there's if you take 317 with me, there's a portfolio statistic called alpha. Okay, and alpha is a measurement of excess return. Okay, above normal, right? And so it is a risk metric that we like to look at when we're evaluating one investment versus another. Okay. So market efficiency, this is also very important. Number 3, market efficiency is not going to protect you from wrong choices. Okay, if you don't diversify, you still need to diversify. You still need to lower your overall level of risk, lower your overall volatility to give yourself the best possible chance of achieving the expected return that you're looking for. Okay. So the next 3 slides, we're going to go through the 3 different types of markets. Okay, the first form is called strong form efficiency. Okay, strong form efficient markets. Okay, and in a strong form efficient market, you would believe that the prices in the market reflect all of the information that exists about that business, public and private. Okay, there is no information that somebody else is holding on to. Everything is available. Okay, so if the market is strong form efficient, okay, then the investors could not earn abnormal returns regardless of the information they possessed, because everybody's got access to everything. Okay, so this would suggest that the markets, okay, if we look back at the history of the markets, okay, so empirical evidence, so we look back at the history of the markets, it actually suggests that the markets are not strong form efficient, okay, because we can see over a historical period of time, right, that insiders, okay, can gain a certain advantage, okay, and they can earn abnormal returns. Okay, so if we look back at the empirical evidence within the market, the data would suggest that the markets are not strong form efficient. Okay. Okay. Case in point here, right? So Georgia Senator Kelly Loeffler, right? She sold to protect the losses, but bought to profit. Okay, in the situation that happened, what was it, last year? Okay. So there are, and up until maybe 15 years ago, and I could be wrong on the timeline there, but up until, let's just call it 15 years ago, right? People serving in Congress were exempt from insider trading. They had access to all the new drugs that were coming down the pipe from, you know, the big pharmaceutical companies, and they could call their broker right after they had their meeting and said, hey, Bristol Myers Squibb is about to launch a new product into the marketplace that nobody knows about. I want you to go ahead and buy 10,000 shares of Bristol Myers Squibb, right? If you and I did that, okay, we'd be locked up in jail for the next 25 years of our life. Okay, but up until about 10 to 15 years ago, people serving in Congress were exempt from insider trading policies. Okay, so if you believe in strong form markets, you believe that everyone has access to all the same information. In reality, historical evidence has proven that that's simply not the case. Semi-strong form efficiency. Prices reflect the publicly available information, okay, including information that relates to trading, annual reports, press releases, SEC filings, the 10K, the 10Qs. Okay, so the prices in the market reflect all publicly available information, not private, but public. So if the market is semi-strong, okay, then the investors cannot earn abnormal returns by trading on the public information. You can earn a return. You can still make 12% on the large cap investment, but you can't earn abnormal returns, okay, because you're trading on publicly available information. Okay, so what does this tell us? Well, it tells us that, well, it doesn't tell us, it implies that fundamental analysis, okay, will not lead to abnormal returns. Okay, fundamental analysis, as you remember, is our ratio analysis, where we're using the financial statements to create the financial ratios for companies, and we're using that information to dictate our decision-making process. If we use fundamental analysis and we believe that the semi-strong form markets are efficient, that the markets are semi-strong efficient, it's telling us that using fundamental analysis is not going to generate abnormal returns. It'll generate a return, but not abnormal returns. Okay, so when we think about the smaller, like very low volume traded equities, okay, trading costs are high. Okay, so if you're trying to find a dislocation in the market efficiency, okay, you can probably find them generally on those low volume stocks. The problem is that it costs you a lot of money to find them. It takes a lot of computer power to go find those inefficiencies. Okay, and so the abnormal return that you might gain is offset by that additional trading cost. All right, so semi-strong markets look at the prices reflect all publicly available information. Okay, and that fundamental analysis will not lead to abnormal returns. And that brings us to the final market form called weak form efficiency, right? Where the prices reflect all of the past market information, including price and volume, okay? And if the market is weak form efficient, then investors cannot earn abnormal returns by trading on market information, okay? Semi-strong deals with what the companies have already done based upon information that they've released to the public. Weak form relates to what the stock price and volume numbers have been for the stock investment that you're looking at. So it reflects all the past market information, price, the volume, the number of short sellers in the market. Okay, so if the market is weak form efficient, then investors can't earn abnormal returns by trading on market data, okay, AKA information, which this implies that if you can't make abnormal returns by trading on the market data, what's actually happened, every day of trading for the last 50 years, this tells us that if you use technical analysis, okay, Bollinger Bands and MACD and relative strength and all of that stuff, it tells us that technical analysis is not going to lead to abnormal returns. Okay, so weak form equals no technical analysis for abnormal returns. Semi-strong form equals no fundamental analysis for abnormal returns. Okay, so when we think about looking back at the history of the markets, okay, so the empirical evidence of the market, what we see purely from a data analysis standpoint is that the empirical evidence suggests that the markets are generally weak form efficient. Okay, so that takes us through the three types of market efficiencies, okay, within the efficient market hypothesis, efficient market theory, right? And that also concludes lecture for today. Okay, so that is chapter 12, just kind of some lessons learned from the history of the capital markets. Okay, so what I want to leave you with for today is the important parts around what you're going to need to understand as it relates to this chapter, and as we move towards the final in 3 Tuesdays, well, in 3 weeks. Okay, you're going to need to understand how to calculate returns, both dollar and percentage. Okay, you're going to need to understand how to calculate risk premiums. Okay, you're going to need to understand how to calculate the squared deviations, the sum of the squares, the variance, and the standard deviation. You're going to have to know how to do that. Okay? You're going to have to understand the concept of probability, distribution around the mean, plus or minus 1, 2, 3 standard deviations around the mean. You're going to have to understand how to calculate arithmetic and geometric averages. And you're going to need to understand the differences between strong form, semi-strong, and weak form markets as it relates to the efficient market hypothesis. Okay? Any questions?